Picture this. Joe and Mary homebuyer find the house of their dreams.
So you found your dream house.
They want to make an offer. Their realtor tells them what to do to put a really strong offer together. They offer a little bit more than asking. They really want the house. There are multiple offers. They send their offer in, and then they pray and see what's going to happen. Next day, maybe later that evening, bad news comes in. They find out that they lost out on yet another house, and again, to another cash offer. Sound familiar? Happens all the time. I mean, unless you've been living under a rock these last couple of years, of course you've heard of stories like this. Maybe you are the story. But there's also a good chance, based on the statistics, that Joe and Mary lost out to some kind of an investor. Was it a mom and pop type of investor? Or was it something bigger like Wall Street? Now, while the mom and pop investors are surely buying a lot of properties, like over the course of a year, they'll buy thousands of properties across the US, but they're the ones that typically own between 2 and 9 properties, and they're not paying fair market value. These are the type of investors that you see paying 30, 40, 60, sometimes 70 cents on the dollar for highly distressed properties based on what they're going to do with them. Whether they're going to keep them as a rental, they'll pay a little bit more, or if they're going to try and flip them, they're going to try and get them for a little bit less. No, the type of investors I'm talking about are the big institutional buyers. We're talking about the Blackstones, Progress Residential, Invitation Homes. Those are the type of investors that over the last couple of years have been loading up their inventory with hundreds of thousands of properties. And those are the type of investors that are driving up prices and making it super hard for millennials and Gen Z to be able to compete in this marketplace. Their goal is to turn the single family home into a money printing machine for their stakeholders.
No. I don't believe it.
And it's a bigger problem than you might think. Now, before the last housing crash, no one investor owned more than 1,000 properties.
Is that a lot?
That's a lot.
Now, I know what you're thinking. 1,000 properties sounds like a ton of homes. It absolutely is. I agree with you. But no one investor owned more than 1,000. All of that changed in 2012 when Fannie Mae changed the rules of the game. There were foreclosures everywhere. Banks had taken back hundreds of thousands of properties, and they were trying to figure out what to do. So Fannie Mae in 2012 made it possible for investors, pre-qualified investors, to bid on these large portfolio of properties. So we're talking about 100, 200, 300, sometimes 1,000 properties of homes that were bundled into these portfolios and sold to one investor. So by changing the rules of the game in 2012, they basically opened up the floodgates, and these huge institutional players came rushing into the market to gobble everything up.
Here they come.
And they were buying properties for pennies on the dollar. Now, back in 2009, I got into real estate. And depending on your perspective, that was either the worst time ever to get into real estate.
You don't say.
It was the worst. It was the worst housing crash since the Great Depression. Or, my perspective, it was one of the best times to get in because as hundreds of thousands of agents were getting out of the business, I had less and less competition.
This is fine.
In 2011, I was working with a medium-sized investor. That's an investor that owns between 10 and 100 homes. I remember helping these companies buy homes for $6,000, $7,000, $10,000, sometimes $20,000. And I'm going to show you an example of a home that was purchased for $11,000 in Atlanta in 2011. That property was sat on by the investment company until 2016. They sold it for, I think it was $92,000 to a different investor. And that investor renovated the property and put it back on the market for $387,000 in 2018, and that's what it sold for. Now, what's really striking about this whole scenario to me is just how much money was lost by the American public. So basically, these investors bought up the recovery. Now, what happened as the market improved and foreclosures disappeared? Well, the institutional buyers shifted their focus from the foreclosed properties straight to single-family homes that were owned by regular people. By January 2020, investors were buying 1 out of 5 homes in the entire US. Fast forward 5 years into the future, and that number is up to 30%. In some parts of the country, it was even higher. So if we look at Houston, Dallas, Phoenix, Los Angeles, and Atlanta, the numbers were higher. Now, CoreLogic goes on to say that 60% of all of these investor purchases were by the smaller mom and pop type investors. So the ones that own between 2 and 9 properties. They also make it a point to say that there's no institutional investor in any market that bought more than 5% of that market's inventory. That's interesting to me because I think that they're making a consolidated effort to minimize just how many properties are being bought up by these institutional players, because over the last 5 years, they've done nothing but increase the velocity, the rate at which they've been purchasing.
Very interesting.
And now the top 10 players, the Blackstones, Progress Residentials, Invitation Homes, and so many more, collectively own 450,000 houses across the US. The top 5 players own 300,000 properties. And some of the biggest ones, like Progress Residential, has under management 85,000 properties alone. That's on their website. And if you recall, before 2012, no investor owned more than 1,000. So they've picked up hundreds of thousands of properties in some cases in just the last couple of years. How is that not alarming? Now, you want to know why prices get driven up by these institutional buyers? It's because of what they offer. So in Atlanta, one of my clients sold her property just a couple of years ago to Main Street Renewal. Main Street Renewal paid $15,000 more than the best offer we got. And they bought the house as is. They closed when my client wanted. It was a really good situation for the seller.
Wow, that sounds like a really good deal.
As much as she wanted to see a family buy her house, it was hard to turn that extra money because she was going to use it to compete on the next house. So are you starting to see how these institutional players basically are contributing to rising prices and rising cost of living, right? When they buy up all these properties, but they're not the only type of institutional player that contributed to rising home prices. Have you heard about iBuyers? Now, if you're not familiar with iBuyers, think instant buyers. So they use technology to make quick cash offers for people's homes. So companies like Opendoor, OfferPad, formerly Zillow Offers, these are all iBuyers. And what they do is they pay cash for a house. They'll typically close on a time frame that's convenient to the seller. And for the longest time, they were offering fair market value or more for these properties. And that got Zillow into a lot of trouble.
Some people are turning to an unlikely potential buyer, the popular website Zillow.
Zillow Offers is a new way to sell your home.
Zillow announced Thursday its Zestimate is now an initial cash offer for eligible homes in more than 20 cities nationwide.
A few moments later.
And new at 5, a major announcement from Zillow. The Seattle-based company is dropping 25% of its workforce and closing its home buying business. The move following a low third-quarter earnings report and plunging stock for the company. Bloomberg reporting yesterday that Zillow is now looking to sell 7,000 homes to the tune of $2.8 billion.
Zillow. So essentially, these companies would buy the homes, fix them up. They used to fix them up a lot more than they do now, and they would put them back on the market at a higher price. And how they would basically contribute to home prices rising, well, they would litter a certain area with their marketing.
There was trash everywhere.
So chances are you may have gotten a postcard or several from Opendoor offering to pay cash for your house. So you'd go to their website, you'd pop your address in, they'd send you an offer. You're like, wow, that's amazing. I'm going to take that offer. So these companies would buy one house in a neighborhood. Neighbor would talk to the neighbors and be like, hey, I got a great price for the house. See you later. That second and third neighbor would then sell their homes to the iBuyers. And then every house that sold would raise the price in that neighborhood a little bit. And then in some parts of the country, neighborhoods that started off at $300,000 would soon find themselves being $450,000 neighborhoods, sometimes in as little as 6 months. So you can imagine that before that, the type of buyer that would buy in that neighborhood was qualified up to $300,000. That's who would typically buy there. And now that these homes are $450,000, well, Mr. and Mrs. 300,000 can no longer afford that. Rather, they got priced out of the market as these home values shot up very, very quickly. Now you can see that depending on where we were in the market, these companies had different strategies and they shifted gears, right? Back in 2012, they were buying portfolios of foreclosures, and that continued until the foreclosures dried up. And then they set their sights on single family homes. And that's a trend that is still continuing. They're still buying single family homes from people now. But there's a trend that's emerged since 2020 that has really completely changed the game for these institutional buyers.
Now, you've probably noticed them. These brand new communities and neighborhoods that popped up overnight with these brand new houses. But there's a catch. They're not for sale. They're for rent.
And they were purposely built that way. Kind of reminds me of this. Have you seen this in 2016 from the World Economic Forum? You'll own nothing and you'll be happy. Yeah, life by subscription. They're being touted as a way to help solve the housing shortage by adding supply to the amount of homes that are available. And whether a house is for sale or if it's for rent, so long as it's on the market, it's available for somebody to live in. But are they really helping to increase the housing supply? Or is it a new way for institutional buyers and investors to just print more money? Let's take a look at that. Now, these neighborhoods have become really popular over the last 5 years. And when you think about it, it makes complete sense, because if you're an institutional investor, would you rather buy 100,000 properties from 100,000 different home sellers with 100,000 different financial situations, or would you rather buy them from a single seller? So it's no surprise that builders, some of the nation's biggest builders, are getting into this game as well. As a matter of fact, the top 5 out of 6 home builders in America are all involved in this space, from D.R. Horton and Lennar to Pulte Group, Toll Brothers, and Taylor Morrison. They're all building these build-to-rent neighborhoods. Now, it's hard to fault the builders for wanting to fill these orders for these institutional players. They buy a lot of houses, and you're dealing with only a handful of decision makers versus thousands, right? So it makes sense. And these institutional players have basically jumped 2 feet first into this game over the last couple of years. Blackstone acquired Tricon Residential. Tricon is a Canadian developer. They own 38,000 of these type of homes in the US. That's under Blackstone's umbrella. And Blackstone has pledged to build another $1 billion worth of these homes moving forward. Well, it's the same thing for Invitation Homes. They have another $1 billion earmarked as well. And now you've got these alternative asset management companies like Pretium, for example, out of New York, that's going to finance $2.5 billion worth of neighborhoods. Now, what exactly are they building? So right in my backyard in Metro Atlanta, there's a community called Cedar Crest Station. There are these communities everywhere, but this one is 2 counties away from Atlanta. It's kind of in the sticks, to be honest.
Yes, it's in the middle of nowhere, yeah.
But people are paying top dollar to be in that community, $3,000 a month, all the way up to $3,500. So between 2022 and 2023, we don't yet have 2024 data. That's going to come out soon. But what we do have is the difference between 22 and 23. And there were 58,300 less housing starts. So a housing start is somebody walks into a new construction neighborhood, they place an order with the builder to build a house that's going to be built 6 to 12 months into the future. But it could also be a spec home, so a home that a builder starts that they don't yet have a buyer for. So year over year, 22 to 23, down 58,300. Now in that same time period, these build to rent houses were up 6,000. So it seems like builders were favoring building these build to rent type homes. They weren't building quite as many build for sale homes. Now there's a good explanation for that. What happened over the last couple of years? Interest rates, right?
Interest rates are skyrocketing.
They went up, and it's normal that when rates go up, affordability goes down. So you're going to have less orders for new construction as a whole. People do prefer to rent, so demand shifts a little bit from one side to the other. But that's a big net negative. We're at a net negative of approximately 52,000 houses over the course of that time period. These institutional investors, they've got their hands in everything, don't they? I mean, how do we even compete? So I've got a couple tips on what you can do to put yourself in the best possible position to compete with a cash buyer, whether it's an investor or somebody relocating from, let's say, California. So first and foremost, if you're going to get a loan, don't just settle for being pre-qualified or pre-approved. There's an extra level called pre-underwriting. And when you're pre-underwritten, you've had an actual underwriter look at your file and review it. You're sending in, obviously, all of your documents, right? Pay stub, bank statements, tax returns. An underwriter might ask for additional things It's a lot of extra steps to do at the very beginning of the process, and a lot of people don't want to go through that trouble. But I'll tell you what the power is if you choose to go that extra step.
I'm listening.
When positioned properly, that pre-underwritten letter allows you to do a couple things. You could potentially forego your financing contingency. Risky, but calculated risk. 2, your turnaround time for closing on a property puts you on the same level as a cash buyer. So what's nice about cash? You don't have to worry about financing. 2, you can typically close very quickly. So if those are 2 factors that are very important to a seller, when you're pre-underwritten, you can close quickly when a borrower is pre-underwritten. The second thing that you want to do is find yourself a real estate agent that understands the difference between pre-approval and pre-underwriting, and not just that, but knows how to position it when they're trying to sell your offer to the agent representing the seller. Because not every agent understands the difference between these, and it's important to be able to explain what those differences are so that when you're positioning your offer, that the agent that's receiving that information knows how to explain it to their seller as well. Now, if you don't already have a great agent and you want to work with somebody that does understand that difference, but you want to take the guesswork out of trying to find that right agent, I'm connected to great agents all across the country. So if you'd like my help to be introduced to somebody awesome, in the description and in that first comment, I've got a link. Fill out the form. We'll have a conversation to see exactly what you need. Be happy to make an introduction. Something else your agent should be able to do, for example, if these cash buyers are really dominant in your market, you can pull up and see where they're buying. Look at the data and then decide where you could potentially buy that's not in one of their hot buying areas if they're actively buying in your market. Now, of course, there are other strategies that a good real estate agent can walk you through. Like, we haven't even discussed off-market opportunities, but sometimes considering a brand new market might be the way to go. If you live in a relatively expensive or a very expensive market and you're a remote worker, you have no risk of being called back into the office, then you have a really good opportunity to consider a market that might be a lot more affordable if you're willing to up and move to a different city. But before you do, I'd recommend watching this video next